Welcome to this short video with a focus on stop losses and hopes to answer the question about why your stops keep getting hit. Does this sound familiar at all to you? You enter a trade with confidence, of course, and then you get stopped out within a few bars. Watch your position immediately reverse, which would have been in your favor if you'd stayed in, and you see small losses pile up over time and rinse and repeat. If this sounds like you, then hopefully this video will give you some guidance and possibly a tactic to enable you to manage this a little better. So why does this happen? Well, the real reason your stops get hit is that often because of positioning. Market makers hunt stop clusters. They know where people place stops, generally speaking, because it's pretty standard. Algos are exactly the same. They target obvious levels. And of course, then we've got normal or changing volatility hitting tight stops. Poor placement of stops makes them easy targets. And of course, your loss is someone else's profit. And your job and your responsibility is to try and reverse this. So you want the profit in your account, yes? So let's look at three key mistakes that people make. First of all, it's the use of round numbers. Everybody does this. It's a natural human thing to look for something that feels familiar, something that feels obvious. But of course, what that round number is will be dependent on the instrument and the pricing. What we tend to find is that there's massive stop clusters forming around here, as well as limit orders in the opposite direction, which makes it a target for market makers and experienced traders because they know that this is the case. The solution is easy. If you're tempted to put a stop near a round number, always offset away from that. So, for example, if your temptation is to put a stop at $10, then perhaps $10.12 with a share CFD. With FX, then 120 would be a round number. So maybe 119.6. So offset away from round numbers. Mistake two is using percentage-based stops because the same percentage isn't necessarily the same level of risk. So if you adopt the approach that I'll risk a 1% price move on every trade, a 1% move is very different depending on the instrument. We'll show you this in a moment. Of course, volatile stocks and volatile FX pairs need wider stops than those which are less so. And of course, around news releases and session opens, this may change significantly as we get a significant rise in market participants and potentially a sentiment change as well. So what I'm saying is the bottom line is some adaptation may be needed to accommodate an instrument's normal volatile personality. And even worse than percentage-based stops would be a dollar-based move. So a standard 20 pips or 20 points for every trade. Clearly, a 20 pip move on a 5-minute chart could be very significant, whereas a 20 pip move on a 4-hourly chart is barely a blip in the price move on that particular time frame. Mistake three is to ignore market structure. Stops often respect key levels, so avoid arbitrary distances from entry and use key levels as a guide as to where to place your stop. If you ignore support and resistance, especially across multiple timeframes where limit orders sit, then that could be to your detriment. If you want to stay in a trade, you need to avoid a support, for example, and place it just beneath. Ignoring support and resistance, especially across multiple timeframes where limit orders sit in abundance often, is something that you don't want to do. If you are long a trade and potentially using a support level as a stop, place your stop beneath that support level. What that means is the market makers and experienced traders will take it down to that level, take it all up, take all those trades up, and then you will see it move up again. Meanwhile, of course, if you've placed it beneath the support, then of course you're still in the trade. Technical levels matter most as previous price action often dictates current price action. So always look back on where swing highs and swing lows were, as well as the support and resistance for guidance about where to place your stop and where it might be triggered should you do so. Let the chart guide you. Give yourself some space between these key levels and where you want to place your stop. So what's the solution to all of this? Well, we've given you some clues already in terms of offsetting, uh, where you're placing it, away from round numbers and away from key levels and support and resistance lines, but possibly using an ATR might help. Using an ATR multiple, for example, 2 times the ATR, is a potential solution to meet many of the issues associated with the methods that we've already talked about. The ATR adapts to each instrument's unique volatility and pricing. That's the benefit of it. And of course, it adapts to time frame as well. Takes into account normal price movement so you can be sure that if you place a stop accordingly, that it is consistent with how the price moves on that particular trade that you've taken. This reduces false stop outs and hopefully enables you to develop a consistent method that adapts across multiple primary timeframes that you use for your entry. So let's have a look at a chart. We're going to look at the US yen. You can see here we've got a potential breakout at around about 148.98. We'd probably give it a little bit of space to get over 149, maybe 149.20. And mistake number one, of course, would be to put the stop at 149. So we may be tempted to place it around about this level here at 149.80. We could also use this key level. We can see it's been trading in a very tight range for the last few hours as our stop again. What we may see is it come down, test this, and subsequently bounce again. So once again, with our key levels, we may push this beneath this price action here, giving it plenty of time to breathe while still enabling us to manage risk. From a percentage point of view, 0.5% move on this is around about 70 pips. Whereas if we looked at another pair, such as the Aussie Kiwi, which is more highly correlated and priced differently, a 0.5% move would be around about 55 pips. So a big difference in how much risk we're willing to take, depending on the underlying asset. Far better, though, as I've already said, than using points. How about if we used our ATR? Well, if we look at the ATR, current ATR on this is around about 24. 1.5 ATR, if that was going to be our level, would be 36 pips. So if we place it 36 pips beneath our signal line of 148.98, that would be 148.62. So just down a little further. And this responds to pricing, it responds to time frame, and gives the market plenty of space to move, again, while still protecting risk. Of course, if we were to trade this on a shorter time frame, for example, the 15-minute chart, you'll see our ATR will drop to 11. So 1.5 times this would be around about 16 pips, which would be a lot tighter because of the tighter time frame that we're trading. Conversely, of course, if we're using the 4-hourly chart, then our ATR on this is around about 41. So it'll be about 60 pips beneath our signal line, which will give us plenty of space on the 4-hourly to move as a 4-hourly chart does. So what we're talking about here really is something that allows consistency and means that fewer stops are hit by simple market noise. You're responding to the breadth of the market, not just an arbitrary number. We do have some challenges with this, which you need to consider, of course, for those of you who are more experienced. What level of ATR multiple is right for you? So we showed on the chart an example of 1.5. Is it 1.5 beneath signal line? Is it 1.5 beneath entry? And of course, is it 1.5 at all? It could be 2. You need to make that decision. Perhaps look back at previous trades and see what would have worked for your particular trading style. Another challenge is that does it need to be dynamic, i.e., it moves with the ATR, or is it the ATR that you're using at entry time? Arguably, if volatility is low in the Asian session, for example, and then picks up in the European session, you could find yourself just taken out simply because of the session change and the slight increase in volatility. If you have a dynamic stop based on ATR on the last bar, then perhaps that accommodates that a little better. And of course, we're not just going to sit there with our stop. We're going to make a decision on how and when we're going to trail that stop upwards if a trade moves in our desired direction. Of course, we've done other videos on that. So your challenge is to review your existing practice in light of the information covered on this video. Ask yourself the question, is there any way that you can refine what you're doing now to potentially create better trading outcomes? As I said, a great start point is to test this out against previous trades and compare the results. Should you have used a system like we've described here versus what you actually got? I hope that's been useful and given you something to test out in your own trading. Trade safe and see you again soon. Bye bye for now.